Thank you again, everyone, for joining us for this month's webinar. We're going to be highlighting some really great upcoming changes from the Secure Act 2.0. We'll get into that in just a moment. But just some items here we want to mention. We've got 2 new team members here at Arista Wealth Management. Jordan Naffa, our senior financial planner, who has quite a few designations. So it's good to have him here with the team, as well as Samantha Foster, who's working on our marketing. So great to have both of them join us. Okay, Paul, do you want to jump in and introduce our webinar topic a little bit here?
Yeah, we're excited to have everyone join us. We want people to feel secure about Secure 2.0. Secure 2.0 was over 4,000 pages. None of the legislative people that voted on it really understood it. Unfortunately, that's sort of a trend that is pervasive back there in Washington. But they all put in their special projects and their special spending bills. And there were some great presents and gifts for those that are close to retirement and those who run businesses. And so we wanted to get this out and start talking about it. I was on a flight yesterday, and I was reading a 300-page document. There's still so much being digested. Secure 2.0 came from Secure 1.0, which was passed in December of 2017 and then actually 2019. So there's a lot of changes going on, but the main things that we want to talk about today is the big changes in RMDs, also the employer Roth account changes, Roth IRA updates, 529 to Roth IRA, also changes not included in the bill, some things that will probably come up in Secure 3.0 because they've already found some holes that they've got to close and close the gap. But let's jump into it. There's a lot of changes, and we're very excited to have you join us today. So the history of Secure 1.0 was some great things. RMD got changed. The big change of Secure 1.0 is the beneficiaries, the designated elective beneficiaries, the DEBs. Those are still there. Also, from Secure 1.0 to 2.0, the backdoor Roth did not get shut down either. We do that for many of you. That is still, it did not get put in, did not get addressed, but did not get eliminated. And that's where some great things are happening with that. But as I said, December of 2019 was Secure 1.0, and now here we are in Secure 2.0 on December 23rd, 2020. And it was sort of Congress's Christmas present.
They give Christmas presents, Paul?
You know what? They do. They do, Zach. For many years, the QCD, the Qualified Charitable Distribution, was granted for 4 years in a row in December. Well, now it's permanent, and QCDs are a great charitable giving. It's a great way to take an RMD instead of bringing it home to the family. You can send it to your favorite charity or church. We do a lot of those on a yearly basis, but we're really excited. There's a lot of good changes.
Perfect. Well, let's jump into the first topic here, which is our required minimum distributions. Good news for those of you who are retired, getting close to those required minimum distributions. Those have actually been extended out. So Secure Act 1.0, or the original Secure Act passed in 2019, changed that RMD to 72. Well, with this Secure Act 2.0 that's now passed, that has been extended out even further. We've got this little chart here to help give you a visual, but those who are born between 1951 and 1959, your RMDs will now begin at age 73. So you have an extra year on that. And that's beginning this year. So if you were required to start those RMDs in 2023 at age 72, you now have up until 2024 to start that RMD. And then those who are born 1960 or later, this will be extended out even further to age 75. And so this is great news. The government forcing you to take those distributions, giving you some more flexibility as to when you start to take those required minimum distributions. So
this is exciting in regards to retirement plans, business owners. I see Cindy Ryman, Rick Watson, Matt Swan, and many others, even William Hinsdale. Welcome, William. With 401ks, 403bs, 457, SEPs, all these retirement plans that are out there, some neat things have happened with the Roth feature built into these plans. We can't overemphasize the importance of all investors having some type of a tax-free bucket. What's beautiful about this Roth feature, Senator Roth, Democratic senator, probably the only good one. Sorry, I didn't say that. He started this post-tax, after-tax money that can go into a tax-deferred, tax-free account, and no RBD and RMD. So there's no forced taxation. And it's a great feature that someone can put money in and have it grow tax deferred, have it also be creditor protected, and then have no forced distribution with that. It's now been added to all of the accounts. And also as the corporation puts money in to match a participant or owner's money, the corporate money can also go in the Roth. So there would be match money, call it whether it was a 3, 4, 5, 6% match. That match would now match where the participant or owner has elected to put his money. So really, really a great thing there with Secure 2.0.
And this is effective 2024. So starting in 2024, those employer matches, just like Paul said, can actually be made via Roth. And so, however, one thing to note here, because the Roth is post-tax, you're getting that tax-free growth, that match amount will be included in the employee's income for the year. So you get that 3% match. Previously, you didn't have to pay income tax because it's tax deferred. But now that you change it to a Roth match, that would be included in the employee's income. So really some great things there. In addition to that, there's a couple changes on the Roth 401k side. Your deferrals in the plan, if they're Roth, previous to Secure Act 2.0, those were actually subject to an RMD. And this didn't make a lot of sense because the Roth IRAs were not subject to the RMD, while the 401k was. And so Secure Act 2.0 has just made it consistent across the board that whether it's in a Roth IRA or a Roth 401k, those required minimum distributions are not required from either of those accounts. And so that starts in effective 2024. So one thing to keep in mind is if you do have an RMD in your 401k for 2023, you will be required to take that out even in the Roth portion. So just one thing to note there, but some great changes to really simplify things.
The 401k automatic enrollment, this is really important. For many years, if corporations and businesses did the automatic enrollment, there were some benefits. Now there's more benefits, but now it's being required. What's interesting is when Social Security was created, there were 10 depositors for one beneficiary. What's projected in the next 5 to 10 years is there's going to be 7 beneficiaries for 3 contributors. So, and also the undercurrent of 4,000 pages of legislation is that retirement is coming for many, especially the baby boomers, and the ability for the government to continue to make these payments, it's just starting to become a daunting task. So they're requiring businesses, once they're eligible, to start enrolling their employees. And they're also going to allow some tax credits to be given to some of these businesses that still do not have a 401k plan. But it requires employers to establish these new plans. It's a forced contribution. I think it's a really positive thing. Many individuals, when they have a dollar, think of how can I spend that dollar today, and they lack that disciplined structure and importance of looking to the future and planning for that. But it is something. This starts in 2 years, but this is the 401k automatic enrollment is a great addition.
In addition to that, in the 401k, there's going to be an additional catch-up, and we're going to call this the super catch-up because of the amount that you can contribute. This is for participants who are age 60 through 63. They will have an additional catch-up, either the greater of $10,000 or 150% of the regular catch-up. So right now, participants over age 50 get the catch-up provision. And so this will expand that catch-up and allow those who are closer to retirement to fund even more into their 401k. So this is great news for those who are nearing retirement. They'll be able to save a lot more into their 401k and help them get ready, as well as those big tax deductions that they can get. So we've got a little example. Quentin, age 62, a partner in a law firm, sponsors a 401k plan. So he can contribute the following into his plan for 2023. His deferral limit, which has increased from 2022, is now $22,500 is what he can contribute. The additional catch-up, being over age 50, he can contribute an additional $7,500, so a total of $30,000 for anyone over age 50. Now, because Quentin is between the additional catch-up age, he can contribute an additional $3,750. So his total contribution will be $33,750 that he could contribute into his 401k. So really some good news there.
Yeah, and then if there's a company match of 3, 4, 5, or Apple Computers 6%, I mean that's just a ton of money that can be deferred. Corporations get a tax deduction, but Quentin, if he starts, if he'd start a little bit sooner, he'd have more. But that is a great benefit for deferral, catch up, and super catch up.
Yeah, absolutely.
In 2021, the EGTRA created that IRA catch up for IRAs, and that is now going up. The PPA of 2006 doubled it. But starting in 2024, Secure Act 2.0 will finally allow that IRA catch-up contribution limits to automatically adjust for inflation. This was another Christmas present that we got last month, Zach, that we've got this adjusted here, clients. We also have an adjusted inflation on the 415 limit that is coming for those that have cash balance defined benefit plans. That's now adjusted for inflation. A lot of matrices have been adjusted for inflation, and especially with the Department of Labor's inflation adjusted number that came out on December 16th of last year, you're going to see a lot of these 2023 numbers. Inflation officially was 8.6. It's the third time in the last 50 years that we've seen a number greater than 5. So, these numbers are going to be really large. And so it's a big Christmas present, one of the bigger Christmas presents behind the Christmas tree that we got last month, Zach.
Yeah, absolutely. It's been 15 years, Paul. That limit has not changed. It's stayed at that $1,000 since 2006. So great to see that they're finally making some of those adjustments that will help these retirees and anyone who's trying to save for retirement. In addition to that, they've expanded both the SEP and Simple IRA. Previously to Secure Act 2.0, those were only offered pre-tax. And so now with Secure Act 2.0, both a SEP Roth IRA and a Simple Roth IRA have been created. So these are great options for those who are looking for a more simplified approach to a employer-sponsored plan. They want to keep fees low, record keeping low. They want to keep just the daily administration simple. These types of plans are better for those types of purposes. So great to see that the Roth has now been expanded in those as well.
This is some exciting news. Starting with Secure Act 2.0, we can roll over $35,000 in a lifetime to a Roth IRA from a 529. 529 started in 1999. Merrill Lynch, one of the large firms on Wall Street where I worked prior, their lobbyists are the ones that got the 529 initiated. I was part of that national rollout team for the West Coast when that came out, the 529s. We also got some big changes with 529 changes 2 years ago under Donald Trump's legislation, just before he left, where the numbers have gone up, how you can use 529 money, golf schools, cooking schools in Italy, ski schools up in Colorado or in southern Spain. But we're just seeing some additional benefits being added to 529 accounts because these accounts now have been around for 22 years. And we're seeing multi-million-dollar 529 accounts. We can change the beneficiary. So if grandchild 1 doesn't need it, we can change it to grandchild 2 or 3. We can change it inside the family or now even out of the family as long as the grantor are the same. So some really cool changes also here. This was also another Christmas present from Secure 2.0.
And just to add on to that, some things to be aware of. This 529 needs to be open for at least 15 years. And that $35,000 lifetime limit is a lifetime limit, but it's also subject to the annual contribution limit. So we've got a little example here on the next slide. Todd's a beneficiary of a 529 account that has excess funds that he won't need for school. So the account's been open for at least 15 years. Todd's father, who is the owner of the 529, can transfer up to $6,500, which is the annual contribution limit for this year, into Todd's Roth IRA. So that's the name of the student who's 529, who was the beneficiary of the 529. So it's subject both to the annual limit as well as the lifetime limit of $35,000. But really some good changes there. There were some changes that were not included in the Secure Act 2.0. That's actually some good news. First, the elimination of the backdoor Roth did not make it into Secure Act 2.0. So the backdoor Roth is still available for those. There's no income limit on that, and that can still be completed. So that's some great news. And in addition to that, there's no new limits on who can make Roth conversions. You can convert that money from traditional over to Roth, no matter how much income you make. And there was also 2 other changes that are good news. The QCD can be made, and it's going to be indexed with inflation. So there's no changes with the QCD and eliminating that awesome feature as well as there was not really much clarification on the 10-year rule. So we're expecting some additional clarification to come out on this. The 10-year rule goes back to the eligible designated beneficiary and the beneficiary selected for a retirement account. So if the beneficiary of the retirement account is less than or greater than 10 years of age from the owner, right now the rules are, unless they're a minor, there's a couple exceptions, but the general rule is that the beneficiary has 10 years to take that money out of the retirement account. But there's no clarification as to if there has to be an amount taken out each year or if it's whenever the participant wants. That's kind of been in a gray area for a while, but there was no additional clarification on that. We're expecting that to be proposed soon and see some additional legislation on that.
And Zach, just a quick item, that third bullet point, QCDs, with the stated rate from the DOL of 8%, the QCD limit's been 100,000. We have quite a few clients that hit that limit every year. So for 2023, it's 108,000 that they can take out of a qualified account, IRA, and give it to charity. So the government doesn't hit your taxable income. The charity wins because they need the money, and it also satisfies an RMD. So, I mean, that number, it's just neat to be able to see that happening. And a lot of clients are happy about that because they can give more money to their church and to other meaningful charity and organizations that can use the money.
The QCD is like one of the Dodgers players getting up and hitting a home run, Paul. It's really a triple play. So
that's right. Yeah. So just a couple of summary items. This just gives you a visual, and I do believe that Secure 3.0 is out there. There's some other gaps. Don't want to go deep into it. We have Matt Swan, a very educated CPA. We also have William Hinsdale, who's also a CPA. There's just gaps because we swim in this water all day, every day. And who knows how long it's going to be, but there's some great things. But this is the timeline where you are, that you just have to be aware of it. One of the other changes is that the RMD, if you didn't get it out, there was a 50% penalty. That's down to 25%. So that's been eliminated. That's been reduced. It's still sort of a self-reporting, honesty, Boy Scout method that they're using. I believe government is going to be putting some measures in place. But here's some timeline. Hate to introduce new stuff, but also Secure 2.0. This is pretty neat. It's mandating a new government database to be created, where if an employee leaves, their money stays behind, and many times it gets pushed to the abandoned property division. California's abandoned property division is over $4 billion. Nevada is like 1.3 billion. Whatever state you're in, we think this is a very valuable resource. Go in and type your state and type abandoned property. You'll get taken to the state website. Put your name, your full name in, and it will pop up. We do this. I had a client walk in just a few years ago. I did it, and there was a $200,000 account attached to his name, and very well-known person, and it was his second wife. And she said, "How soon can we get that money?" I said, "You know what? I'm just letting you know it's in Texas. Did you used to live there?" And he says, "Yes, I lived there. I was a golf pro there." And but so there's that being formed, 401ks for employees as they move around. There's going to be an aggregation software database for that. Hate to get anything exciting knowing that the government's going to be in charge of it, but it is out there. But we have classified documents showing up at our current president's house in Delaware, and he didn't know that they were there. So it does worry me a little bit about government getting involved in the 401k aggregation reporting business, but it is what it is. But there's a lot of things coming down the pike, a lot of credits, and also a lot of RMDs based on people's ages.
And Paul, this timeline right here, there's a lot of information there. It just really stresses the importance of staying in contact with your financial advisor, making sure that you have someone who's watching all of these things who are coming out, being proposed, coming up, so that you can take advantage of all of those great opportunities there. We don't want to pay any more taxes than we have to. So let's do everything we can to follow the guidelines and regulations that are put out there, but really just to maximize your portfolio. So really just stay in touch with us. We'll continue to monitor these things and keep you updated on everything. So really just in summary, to highlight a couple other points here, if you were to just take away a couple items, here's the things to remember. Required minimum distributions, RMDs, are delayed to age 73 and in some cases 75. Employers can now offer the Roth match, and there's an additional match for those 60 to 63. Both great things. As well as a third point to remember here, Roth IRA catch-up is going to be indexed for inflation. If you don't currently offer a 401k plan, you want a simplified approach, but you want the Roth feature, those are now available through Simple Roths and SEP Roths. In addition to those items, we have just two other items, number 4 and number 5. Owners of a 529 account can roll over into the beneficiary's Roth IRA. starting in 2024. And then also number 5, there's no changes to the backdoor Roth, no limits on Roth conversions. So those are still permitted and we can still assist you in all of those conversions.